Good day, everyone. I'm Michael Chang, Chief Investment Officer for Fixed Income at RHB Asset Management. First of all, thank you for listening to this podcast. I believe for the most of us, we are wondering where markets are heading, and today, allow me to share with you some views focusing on bond investments. This is a time when sustainability of portfolios will matter to withstand the rough edges of the present investment climate. While the current market volatility is unprecedented, alluding to the magnitude of losses, but we believe there is hope in every market cycle. Now, only time will tell if these decisions make absolute sense when fear abates. Hope could mean the trend of COVID-19 cases plummeting, reduced lockdowns, discovery of COVID-19 vaccines, which will then set global growth to restart again. Given how sharply markets have adjusted recently, there are values emerging, and one must know how to identify these gems and to stay invested in them. While there are risks, but at the very least, these have been priced in. Smart investment decisions can only be made if we believe there is hope. I will take you through to the market outlook. We are looking at containment of COVID-19, and this shows how selected countries are battling COVID-19 respectively. Clearly, China and South Korea have reached containment. For Malaysia, we are starting to see some silver lining here in terms of COVID-19, even though the Movement Control Order MCO have been extended till 28 April 2020. If we look at the COVID-19 cases by country and the pattern of the graphs, we can see some form of containment soon for Malaysia if the MCO is strictly adhered to. That said, there are countries that we expect further deterioration of COVID-19 before it levels off and stabilizes. That would be the US, UK, Italy, and Spain. Now, because of COVID-19, central banks around the world have responded in a concerted manner to cut rates and injected liquidity within their financial system. On 3rd of March, Bank Negara cut the overnight policy rate by 25 basis points to yield 2.5%, followed by the US Fed, where they have also cut 50 basis points on the same day. We then saw People's Bank of China, PBOC, cutting RRR as well. US cut rates again on 15th of March by 100 basis points, leaving the Fed funds rate close to zero. On the 27th of March, we saw Trump unveil a $2 trillion package to save the battered US economy, and the amount dwarfed the $800 billion package Obama signed during the global financial crisis. This time, policymakers are following the whatever it takes approach used effectively by former ECB Governor Mario Draghi during the EU debt crisis. Growth in the combined G3 balance sheet, i.e. the US Fed, ECB and BOJ, suggests the largest balance sheet expansions since 2008. Expanding G3 to G7, it is now the return of large-scale bond purchases by central banks again, where net purchases made in March was about 1.4 trillion, which is close to 5 times higher than the previous peak of 270 billion US dollars in April 2019. For ASEAN and South Asia, the dovish wave persists and cuts were front-loaded. We expect Bank Negara to deliver another rate cut, possibly 50 basis points, in the upcoming 4th to 5th May Monetary Policy Committee meeting, because the COVID-19 impact to the economy is much more severe than the global financial crisis, when Bank Negara cut rates to a low of 2%. Overnight rate spread between the US and Malaysia is at 225 basis points, leaving more room for Bank Negara to cut its OPR. This is also strategic to manage its fiscal deficit, since the Malaysian government tapped most of its funding locally, reducing the need to tap offshore. Transposing these monetary policy moves between US and Malaysia, we definitely see value in the current bond market, more so in the recent bond market sell-off, and yields overall have adjusted higher and diverging from policy rate movements. Post these rate cuts, coupled with the series of risk-off trades from offshore investors, plus the concern on COVID-19, we saw values emerging significantly in the 10-year MGS, because it is now sitting at 264 basis points against the 10-year US Treasury. Even during GFC, average spread was only 120 basis points, presenting an opportunity ratio of 2.34 times to beat MGS. Bonds have indeed sold off during this period, and MGS yields have soared to a high of 3.6% on 19th of March from a low of 2.75 before stabilizing currently at 3.37. The gyration in yields was mainly attributed by fear and market dislocations, which you are aware of. Even gold has also sold off. Stacking these yield movements against various fixed income classes as at 31st March 2020, US high yield and Asian high yield saw the worst dive in prices, where yields have adjusted 5.11% and 5.27% higher respectively. These are in thousands of basis points adjustments. US IG and Asian bonds have also sold off 63 basis points and 97 basis points higher respectively. Given these sell-offs, we believe there is value in the bond market when you start to cherry pick for investments. While the brunt of selling is there and may reoccur, we saw a different reception in new primary issuances in the US dollar bond space. Books were oversubscribed and there were decent trading in these bonds and profits to be made. HSBC Holdings PLC senior issuance amounted to 2.5 billion, 10-year was offering generously at T plus 450 basis point, before it tightened by 35 basis point at issuance, giving a yield of 5% in US dollars. We also saw Indonesia coming to the US bond market to tap 4.3 billion worth of issuance across 10, 30, and 50-year tenors. Timing was good for Indonesia as they managed to print its ultra-long 50-year at 4.5%. We also saw GCC issuances on the 7th of April, where Qatar tapped US dollar funding via its 5, 10, and 30-year issuance, amounting to US dollar 10 billion, where books were 45 billion and overwhelmingly received. Because of these Qatarian issuance, Indonesia's recent US dollar bonds sold off in the secondary market as Qatar's sovereign rating is much higher than Indonesia. In short, there is money to be made in challenging times. It is a matter of, are we spotting these market opportunities and taking advantage of these market dislocations? Overall, we wanted to share with you what are the strategies outlined in managing our fixed income portfolios. In terms of US dollar portfolio duration, we will focus on the belly of the yield curve and tactically raise duration for investment grade names while keeping duration on high yield short dated. For yield play, we prefer Asian credits, and we will be managing uptick in credit risk by diversification and of course bottom fish credits that are undervalued. For Malaysia, we will nimble in terms of duration and we are looking to buy at any sharp sell-off. As mentioned, since there are divergent in rate movements between government bond rates and policy rates, we believe yields will have to normalize when fear settles. Values have also emerged post-MGS sell-off in the corporate bond space, albeit selective in our credit selection. In general, we will be maintaining a portfolio invested level of 85 to 95% as we will be living in a longer and benign interest rate environment. Of course, there will be some risks in these strategies, which I have shared them in traffic light colors. Thank you for listening to this podcast. We hope you find this podcast useful and gain insights to the current bond market.